Greeting of the day. Today we'll discuss the fourth session that is about investment in portfolio management or investment in portfolio analysis. That's what we will cover under this session. Today we'll discuss about the investment setting or the allocation of investment and measurement of the investment. So what is investment? We discussed before calculating. We had single investment and portfolio investment. So this lecture is again related to the same. Investment is the current commitment of dollar for the period of time in order to drive the future payment will be compensate the investors for the time founded or committed, expected rate of inflation, and uncertainty of future payment. So when you are doing the investment, that is just for these three purposes. That is time period which you are using your money, right? So the rate of inflation, which is the rate of return you will consider and you will get it, and then the uncertainty means the rate of risk that we have. So for that purpose we are say that we have investment. Now why we invest, right? So why we want to invest and why we are not save our money. So investment is nothing but it is for the saving and for making maximize the amount that you have to make large amount in the future, right? So based on that, that's what we are investing. So it says that they can give up immediate positions of saving for future large amount of money that will be available for the future consumptions. The rate of present consumptions for the high level of future consumption is the reason of saving. So high level we want to consume. So that is what we are using. So in this methods that when we are investing, there are four things are needed to determine the accounting rate of return, the rate of return which you are expected to receive it. So that how to define, that is pure time value of money that we have, that is the rate of interest that we are making. Required rate of return, so the rate we are receiving from the market, so what is the rate? Expected rate of inflation, so what is the rate of inflation in the country, and the risk analysis. So what is pure time value of money or pure time value of money during the period? It is nothing. It is the amount of interest, you can say, or the percentage of surplus that you are receiving on the current money for the future. So that is what we call pure time value of money. Time value of money means that 1 rupees of today is not equal with the tomorrow. So if you can say people are willing to pay more for borrow money and later desire to receive surplus on their saving. So people are borrowing money for their fulfilling their consumptions. In this case what happened, they're paying you in a certain percentage of return to you, but the people who are saving this amount, so they are doing for the purpose of nothing but it is for the purpose of receiving more money than actual. So that is what we are using, the first reason. Second reason, the rate of exchange between the future consumptions and current consumption is called the pure rate of interest. That is what we have under this method that we are applying. And then coming the required rate of return. What is required rate of return? Required rate of return, it is nothing but it is the amount, or we can say internal rate of return or required rate of return. It is the rate where your consumptions, right, is fixed or exceed with the supply income that you have. So the rate of the interest rate which is established by capital market by comparison of supply excess income saving and the investment to be invested and the demand excess consumption at the given time. So we are saving and we have borrowing, so for that purpose we are making the required rate of return. And the last one, that is what we are making the minimum rate of return. So what we should have at least the latest rate, that we should not into the losses, but we should have into profit. So that should be, we are considering the risk premium, and we need to have a rate of interest. So that is what we are considering. Now, what is the effect of inflation for the investment? So if you are investing, what is the effect of that? So if the future payment is diminished in the value because of inflation, the investors will demand higher rate of return than the pure time value of money to cover the expected inflation expenses. So if my if the payment is decreasing due to inflation, so inflation is higher but decreasing, so that is actually expenses for them, because they are losing that amount, right? They are not getting the return of that. So for that purpose, they what will do, they will charge more rate to cover the losses of this inflation. So effect of inflation on the return have more. Even we can say, we can like Japan is having minus rate of inflation, right? America is, I think, having 1 or 2 rate of inflation. So these different countries in Afghanistan may have 8 or between 8 to 12 range the rate of inflation. So it impact. So if our inflation is higher, the rate of return is higher. If inflation is less, the rate of return will be less. So we are considering the rate of return based on that factors. And then coming to the next one, that is uncertainty of risk. Uncertainty or risk, or we can say uncertainty of risk. So if we say these are the 4 reasons that we have, and out of these 4 reasons, we say that when we are determining the risk, expected rate of inflation, required rate, and pure time value of money, so the uncertainty or the risk is nothing, it is the losses, it is the accepting certain losses for the future, accepting certain risk. In simple term, I can say that we normally using that higher risk will have the higher return, lower risk will have the lower return, right? So uncertainty or the risk, if the future payment from the investment is not certain, so the investor will demand the interest rate in excess the pure time value of money plus the inflation rate. So uncertainty means the losses, the unexpected event which is happening in the future. If I'm investing some money, there is 2 concepts. One is investment, second one is loan, right? Investment is what? Investment is that you are investing money, you're supplying of your money for the future return, which should be higher than the interest rate, right? That is what investment actually do. But the return, the loan which we are giving, we are receiving return but lower as compared to the investment. This is also having certain losses but very low level. Even it is risk free, we can call it, right? So which we are having loan. Now when we say that higher risk, higher return, so investment or equity or preference shares, so these are the investments. So we are investing money, so we should have more return than that. But as compared to the debt that is less risky, we are accepting less risk, we will have low return on that. So the uncertainty of payment from the investment is the investment risk. So the additional rate of return add to nominal or risk-free interest rate is called risk premium. So that is what we are using it. What is risk premium? Risk premium is nothing, but it is additional return than the risk-free interest rate. That is what risk premium which we have. So what is the purpose of investment analysis? Why we are investing? So the first purpose, that to know, to help, to understand how to analyze the different investment assets, right? So that is what the first purpose, we have to know, we have to analyze that if we are investing, how we should invest the money in that organizations. Then next one is the nothing but it is the risk return trade-off. So you are comparing to different investment aspects. You're selecting one of them which is return is higher and risk is higher. And then the third purpose is that when we are investing, so therefore you must be understand how to measure the rate of return and the risk involved in the investment accurately. So we have to know what is the risk level and how much return should be they will give me. Can I expect it more return? So that if you are a financial specialist, if you're specialist in the field of finance, if you're working as a specialized person in the any organizations, you have to know about the risk and you have to know about the return, how to decide what is the expected return that you will receive, whether you should invest or no. Right? So based on that, we can say that finance is for the four major goals. One is allocation of money, raising of funds, profit maximization, and the fourth one is risk manager, we can say, to minimize the risk. So we are using. So here, if we analyze, so we have to know the rate of return, where we should have the good return, from which source we should try as many, which is as low cost. And then the fourth purpose is to meet this need in the section that we are examine the way quantify return and risk. The next presentation we consider how to measure the both historical and expected rate of return and risk. So this is how we need to examine and quantify the way that how much return we have and how much risk we have. So for this we have a measurement method. So we discussed already that how to measure. The first measure is historical rate of return individual investment that we are having holding period. So we calculate HPR and HPY. Okay? So the first method is historical based, that is HPR, which you are using to see the investment based on the historical, to evaluate to different investments, based on the same methods, right? So that is what the first measurement. Second one is the we discussed to properly evaluate two investments. So by this method historical, we can measure these different methods that we have. And then the third one is proper measurement of rate of return for the purpose of the sessions which you have. And then we can simply say is that in this measurement history, that when we are investing with different consumptions in order to add our wealth and that we can be consume more in the future, so we are expected return should be higher than the actual the risk which you are considering, right? So that is what we talk about, the return of investment, the wealth resulting from the investment. So we need to calculate, we should have a wealth maximization as well. If you're working as a long-term companies, long-term organization, we should focus on the wealth maximization. So in the wealth maximization, we have to give good interest rate, we have to attract the investors, we have to give them good dividend, and that is what we have to motivate in the positive way, not negative. And then the next one, when which we have historical rate, so we discuss calculating by that method that we have, right? And then the last thing which is for today's session, that computing the mean of historical return. So we are actually calculating what we discuss about HPR, HPY, how to calculate for a single period, how to calculate for a year, how to calculate for different investment, how to compare these things. And then we discuss about the mean, arithmetic mean for the single investment, and then we discuss geometric mean, and then we got about the standard deviation, the expected returns. So this is what we variance, coefficient of variance. So this is all part of these, that how to calculate the historical returns. So we are using it here. So these are different questions given by to you people. You need to calculate HPR and HPY, and this is how you will do it. Here you need to calculate arithmetic mean, and you need to do geometric mean, and then standard deviation, coefficient of the variance. So these different things you have to do by yourself. So these are two questions for your practice. It is there. So I hope you learn something about the investment, and then this is all for today. Thank you so much for your watching. If you have any question, queries, so you can ask me through YouTube channel or WhatsApp group. Thank you.